Hello and welcome to MarketTamer.com's end of day review on Friday, July 24th. Hope everybody had a great day. What we're going to do today is start with a view of the SPY, which is the S&P 500 SPX, the ETF. So if we look what happened yesterday, you can see we had a shooting star candle right there. And then today we had a spinning top candle. Having one of these candles appear near the top of a range or at the top of a near-term range is bearish. Having two increases the clout of this bearish pattern. There's no guarantee a pullback will occur, but having these two together, it's not looking good. If you try to put maybe a probability on it of some kind of retracement, of a retracement at least to fill this gap back to 97.50, or even come back into 95 where there's these swing highs from June. So either one of these areas, right now for a pullback, it's probably looking around 65-70% in terms of probability of a pullback. Hey, that's not a lock by any means. And in fact, the market's been so overbought, which you can tell by the RSI being at or above 70, and in some cases it was even at 75, this market is incredibly overbought. However, that does not mean a pullback will occur. We need to see a crack below the 5-day and then a crack below 97.50 before we even get to 95. So, frankly, the bias is still with the bulls. What this does here is just raise a big yellow flag. So the question becomes, do you keep chasing the rally even though things are so overbought? Well, frankly, until the 5 days broken, the answer could be yes. So if you're concerned about chasing the rally and buying stocks at a potential short-term top, are there some other trades out there, some other strategies that could be used that can still allow you to profit in a bullish trend? And the answer is yes. And one of those strategies is a bull put. So what we could do here is, why don't we take a look at Apple, a stock that I like to trade. And again, here's a 3-month daily chart, just like of the SPY. And these candles are quite similar. Basically a shooting star and a spinning top. Again, those are bearish. You can see here on the 21st, Apple had earnings after market, gapped up the next day, traded a little higher, basically went into a bull flag pattern, and then busted out. But these are bearish patterns. So do you really want to buy Apple up here with the possibility it could pull back $3, $5, or even maybe $10? Maybe not. But if you still want to partake in Apple's bullish trend or potential bullish trend, what you could consider is that bull put strategy. What I've done here is I've drawn in a yellow line right here, a trend line, that cuts across where the gap is. If Apple were to pull back, 155 is probably going to act as some pretty stout support. Why? Well, first of all, you have the gap. You have some horizontal trading here. And furthermore, the 20-day moving average is slowly moving higher. And in the course of another 2 or 3 days, it will be at $155. So you could say, if, for example, if we shorted sold to open, the 155 short put in August, as long as the stock does not break below 155, you're going to keep all that credit. But if we do a naked put, your risk in case the stock were to go substantially lower, could be quite high. So what we could do is do a bull put, whereby we sell the 155 put in August, we buy the 150 put, we'll have a nice little $5 spread, and then our profit will be the credit that we receive for initiating this spread. So as long as Apple stays above 155, that means it can go higher, it can remain sideways, it could even go lower by as much as $8.39. And we will still be able to achieve a profit. So why don't we go ahead and look at what kind of credit we could possibly take in on this 150, 155 bull put. If we sell to open the 155 put, which is at a support level based on my analysis, we take in $1.45 credit. If we buy to open the 150, we pay 77 cents. Now that's going to give us a 68-cent credit. If we take 68 cents and then divide that by the risk in the trade, which is calculated by the difference in strikes minus the credit, that's 432, you're going to see we get about a 15.7% return on investment. We're $8 out of the money, the stock can go up, sideways, even down, we can still achieve a profit. So a bull put can be a great way to possibly take advantage of an uncertain market. Maybe we pull back a little bit, or maybe it goes a little higher. So the flexibility of a bull put is really nice. If you'd like to learn more about that, you can check us out at MarketTamer.com. And lastly, as always, anything we talk about in these presentations are for educational purposes and not advice to buy or sell. We wish you guys a fantastic weekend. Take care.